I think Sanjeev has frozen, it seems. अनिल, मेरी आवाज सुनाई दे रही है आपको?
Yes, sir, you are audible, sir. Chairman sir is joining, sir.
I think he's rejoining.
Hello. Anilji, can we go ahead?
Yes, sir. Kindly, sir.
A very good afternoon to you all, friends. I am Sanjeev Singhal, Central Council member and Chairman of the Auditing and Assurance Standard Board. On my behalf and on behalf of my Vice Chairman, CA Vishal Bhai Doshi, we welcome you all to this important webinar on auditor's responsibility relating to fraud in an audit of financial statements. Friends, this is the 85th program for this council year. So in 3 months' time, we have done 85 programs across the length and breadth of the country, both on physical mode as well as on the virtual mode. And this has been our endeavor to cover all the topics concerning an auditor. So today's topic is also very, very important. And we know that this is an audit season which is going on. And to help you all, we have also come out with an expert panel in which you can raise your audit-related queries with our experts. And they respond within 24 to 48 hours. You have to send an email. And these are responded without charging any fee. This is the world's largest professional helpline, which we are running. And it is running from 17th of April to 30th of September. So please feel free to ask any questions regarding the audit of about 3 million entities, both in the corporate form and in the non-corporate forms which are going on. We have also run a helpline for the bank branch audit, which was successfully completed on 15th of March. Friends, we know that the auditor's responsibility are increasing, and it is increased expectation of the society that an auditor is able to discover frauds. There is a growing perception gap, and we need to make sure that this perception gap is addressed. And one of the way, or rather the best way, is through our audit report. So it is very important that we discharge our duties. However, for the stakeholders also, it is very important to understand that what an auditor can detect and what an auditor cannot detect. So SA 240 lays down the duties of the auditor. There is a long debate on whether an auditor is a watchdog or a bloodhound. And the issue cannot be settled either way. Society will always expect that an auditor needs to be bloodhound, whereas our auditing standards and the leading cases say an auditor is a watchdog. So where exactly we fall? So that is something which will be discussed today. And to take up this topic, we have an extremely experienced veteran of the profession, C. Jitendra Agarwal. I personally know him. He has almost 4 decades of experience. And, he is the one whom we rely on so many roles within ICI. He's been a jury member and, a great speaker. At least I've been depending on him from last 13 years to speak on the various programs. Of course, he has been helping the profession for long. He's a partner with Deloitte from last 24 years. And and he has handled countries, some of the largest audits. He has an in-depth knowledge and experience of reporting under various regulatory frameworks, including Indian GAAP, IFRS, US GAAP, and those of other significant capital markets. He has worked extensively on financial statement audits carried out under PCOB with the record of clean inspections. He also has extensive experience in internal audit, internal controls, forensic reviews, etc. And he has been a member of the Accounting Standard Board as well as the Auditing and Assurance Standard Board, and a regular speaker with ICI and the other industry forums. Though there is a difference in the experience, but we belong to the same college. Our alma mater is Shri Ram College of Commerce. And to me, he's a great friend, a mentor, and a guide. And it's always a pleasure, inviting him and talking to him. So, sir, thank you so much for sparing your valuable time, particularly amidst the busy audit season. Your words are always very invaluable for our members. And we would we would request you to kindly deliberate on the topic. Thank you, sir, and over to you.
Thank you, Sanjeev. You humble me every time you speak so highly. I'm not so great as you put it across to people. I'm just like any other professional, like you and all the other, hundreds of professionals who are on the, line right now with us. And I'm so happy that you keep on giving me these opportunities to speak. More than reading the accounting standard, I can share some experiences that we've had during this life. Just as an introduction, I have been an auditor and an auditor and an auditor throughout my life. I have in the profession, some people do tax, some do others, but I have been fortunate that I've stuck to this line and I have enjoyed the profession. I hope that we do justice to the profession. I'm very proud of this profession. If I have to ever relive my life, I would like to relive my life with the same profession. I can say that with conviction. It's a wonderful profession, and I wish success to all our professionals. With this, I can start off with my presentation if I have everybody's permission to do that.
Please go ahead, sir.
Okay. Thank you, Sanjeev. So as Sanjeev said that, the auditor's responsibility relating to fraud in the audit of financial statements is paramount today. We are, as we give, assurance on the financial statements, reasonable assurance on the financial statements that we audit. We are not expected to detect frauds. We are not expected to find frauds or report upon frauds, but we have to be conscious of the fact that there can be frauds. The expectation of the community is that, we should be detecting frauds. Unfortunately, there have been incidences in the past in industries where there has been fraud. The frauds take place because, the management at times is lax or has colluded. What we have to see at our end is that we do not miss out on anything, any obvious that has prevented us to detect fraud, or we do not oversee anything, or we do not kind of, not report what we see. There are multiple agencies to report. We'll discuss it as we come along. So this is what our responsibility is. With this, let me discuss this topic with you. Before I start my presentation, let me tell you, I've been meeting with some of the regulators in the Ministry of Corporate Affairs, who are part of the Ministry of Corporate Affairs, who are part of the, fraud investigation department, and some others, the enforcement directorate. And they always say that we have to be mindful of what we do. They do understand that it is not a responsibility to detect fraud, but what they say is that the expectations of the public are very different. And the expectations are not only different from the auditors, the expectations of the public are different from the management, from the regulators. So when they appoint a regulator, if something happens, they catch hold of two people, the auditor and the regulator. So they say that please help us. Please do something that we can do justice to society. Have your procedures defined in such a manner that if something wrong happens, we are able to find that, we are able to detect that, and we are able to appropriately report that and not put failure. So that is the broad expectation. And one of the regulators also told me that if it doesn't happen, it shows you in poor light, maybe for your fault or not, and it shows the regulator in poor light that, despite having set up an institution, despite having done all the expenditure, having a lot of officers, they have not been able to pick up anything. So it's a multi-pronged attack. The man on the street does not understand this. There is an expectation gap. We all know that. Having said that, we have to make sure that we have done our job well, so that if it comes up, we are able to defend ourselves. We have an auditing standard. It doesn't mean to say that if we've done as per the auditing standard, we've done our job. I think we have to put our hands on our heart and say, have we done what we were required to do? This is just a guide. The auditing standard, the accounting standards are just a guide. We have to do what is right and what we are required to do to ensure that we leave no stone unturned to make sure that we've done our job in the right professional spirit. So this is the broad structure of the presentation. This is no different from what the structure is no different. The heads are the same and they have defined as they have been defined in the auditing, in the standards on auditing, which is SA 240. So I'd like to start, having given this backdrop, let me start with what are our objectives. The objectives of the auditor are very clearly to identify and the risk of material misstatement in the financial statements due to fraud. So we are concerned about one, detecting fraud and whether there is any risk of misstatement in the financial statements due to that fraud. So what are we required to do? We have to obtain sufficient evidence about these fraud factors about the material misstatement, and we have to define and we have to kind of design and implement tests and responses in that matter. And we have to also respond to the identified or suspected fraud. Identified or suspected. Now, what exactly is a fraud? There is a definition of a fraud. A fraud is, I'm just reading it out from the screen, and fraud is an intentional act by one or more individuals. It could be management, it could be those charged with governance, employees, third parties, just so as to obtain an unjust or illegal advantage. And what are fraud risk factors? These are conditions, events or conditions that indicate an incentive or pressure to commit fraud. We'll come to all this as we discuss our presentation. Now, it says one or more individuals among management. Now, there are two matters in any financial statement. One is errors, the other is fraud. Identification of errors is very simple. Identification of errors is simpler than identification of frauds. So one has to have a different mindset to identify errors and to identify frauds. Errors you would normally identify as you audit the financial statements. But frauds are more difficult to identify because the person who has committed fraud, one, he has committed with the intention of committing a fraud. The second thing, he is in a position to manipulate what he is doing to do a fraud. And as the fraud is done by more senior people in the organization, the detection of that fraud becomes more and more difficult. So this is something which you have to keep in mind. As a result, what happens is that you have to have a hawk's eye, you have to have a lot of skepticism as you do your work, and you have to do something out of the ordinary to detect these frauds. And there are fraud risk factors which you can at times, your procedure should be such so as to uncover the fraud risk factors, to make sure that if there are any fraud risk factors, you pick them up at the right time before these result in. So this is one thing that we have to be very careful as we kind of talk about fraud. So one, fraud is something which can be done by employees, which should be avoided, which is very hard to detect. Keep that in mind. And it also depends upon the skillfulness of the person who does the fraud, the frequency, with the way he can do a fraud. So these are some of the factors. Please keep in mind as you define your procedures and as you go ahead in the presentation. This is an old, what you call standard on auditing, and this was effective from 1st April 2009. So it is not that it is a new accounting standard. This came into effect immediately after Satyam happened. But having said that, it is not related to Satyam. This is normally what you would have done in the course of our audit procedures. I have been auditing since the early 80s or the mid 80s. And we always had a mindset to make sure that there is no misstatement or there is no fraud. Misstatements, as I said, are easy to detect, but errors are easy to detect. Frauds are hard to detect. And even when the standard was not there, way back in the early 80s, I was part of a team where a fraud was detected, and it was detected in a manner which nobody could have expected. So also do not go by your knowledge of the organization. Every year as you do the audit, keep an eye on something that could go. So I've said some of this earlier. So you have to maintain an audit of professional skepticism throughout the audit, notwithstanding our past experience or the honesty and integrity of the management. At times, a person may think that, oh, I've been doing this audit for so many years. This is an honest set of people. He may not, he's somebody we can rely upon. The processes are strict, the processes are very aligned. Even then, please have a professional skepticism attitude for the audit. Yes, there may be honesty, but one person could do a mistake, one person could be a rogue in the whole thing. So keep on challenging yourself as you do the audit. That doesn't mean that you look at everything with an eye of suspicion. I don't mean to say that. But if you have, don't say that everything is wrong. So you don't look at every document as being ingenuine. Don't say that this bill is wrong. But use your professional skepticism. For example, if you're looking at 2 or 3 records and they look similar, supposing you're looking at an attendance record, and there you notice that in the attendance record, in the earlier days, people used to sign attendance record. Those things have been taken away by technology today. But as you would sign an attendance record, if you feel that in the attendance record, the signatures look the same, then you have reason to believe that there is a fraud. But if normally speaking, don't suspect that everything is wrong. Unless and until you have a reason to believe, take all the documents at genuine. Don't say that this bill is faulty. Today, we've come across cases where people have made bills on the computer. And as we do the audit, 3 or 4 bills look similar. So there you have to reason to believe that there is something wrong. But otherwise, take them as genuine. You know, if the conditions identified cause the auditor to believe the document may not be authentic, or the terms have been modified, then we need to investigate further. As I said just now, if there is a reason why you think that this document is wrong, it has been changed for whatever reason, because today lots of things can happen with improved technology. So then you should investigate further. Otherwise, take it on the face of it. Again, another progress factor is you talk to management, you talk to those charged with governance. Those charged with governance means head of the audit committee or the managing director or a director in the organization, an independent director. When we do these discussions, and there are different versions coming from different people. One person is saying something, the other person is something different. For example, let me give you a small example. If you are doing the audit of, say, receivables, your CFO or the credit manager, he says this is a perfectly good receivable. But when you go to talk to one of the directors, they say, no, I know that this company is shut down, you don't get the money. So there is an inconsistency. Or you have reports to suggest that the company that is being talked about, they are under financial stress, whereas the management is trying to hide that, or the documentation is not consistent. So then you have to use your own judgment as an auditor and see what is right and what is wrong. And accordingly, at that point of time, take a call as to whether you need to do further investigation or not. So there could be inconsistencies in what people are telling you. That is a certain reason for alarm. And please go ahead and do a different level of investigation. Now, who does all the work to kind of make sure that you have taken appropriate procedures? It is our engagement team. It is the audit engagement team members that do that work. So we need to have a detailed discussion. How does that discussion help? The senior people have more experience. They may have encountered situations where there is something wrong. For example, in one of my audits that I went for, when we went for the audit, it was meant to be a food company, and they were to stack certain food materials. I won't tell you what material it was, but they were to stack certain materials in a godown. When we went there to see the materials, they took us to a godown which did not belong to them. So it was a huge amount of that material that we had to. For sake of discussion, I'll say okay, it was sacks of the wheat. So they had to show us the sacks of wheat. So we didn't know where they were taking us. They took us to a place and they said, yes, we've got inventory worth say 100 crores, and they showed us those number of bags. When we came back, we got a call that why were you here? One of my team members gave a card there. So when we gave a card, when we came back, we got a call, why did you guys look at our stocks? We told them we had come on behalf of this particular company to look at the stock, and they told us it is their stock. The guy immediately said, no, that is not their stock. This is my stock. I belong to this company. Now, these are the kind of instances that you need to tell your people that this could happen. So you have to be careful about that. So we have a discussion. Sorry. Have a discussion with the team members. Involve them in the discussion. Tell them how to detect a fraud. The fraud can be of misappropriation. It could be of misstatement. So make them aware of everything. That whether it is a misappropriation or a misstatement, it results in a fraud. Anything which could alter the nature of the financial statements that we are auditing significantly, substantially beyond your threshold of materiality is a fraud. So it depends upon whether it is an error or fraud. As I said, a fraud will be when a person is doing it deliberately. An error would be that it is happening by error. Now, this discussion has to take place with the management, with our team members, without giving credence to the fact that the client or the processes followed by the client or the management are honest and have integrity. We do a very, very cold-blooded discussion with our people that these are the instances which could lead to a fraud, and we have to be conscious about them. If the team members do not understand, I think you will not be able to do justice to this particular aspect of detecting the fraud. So the team members' knowledge is very critical. In addition to this, we also have 1 minute. Let me just remove this from here. In addition to talking to our team members, what is very important is our inquiries on management. What is the management's assessment that the financial statements could be materially misstated? So we have to talk to the management as to how they ensure that their processes are such that it will not result in any fraud or any misstatement of the financial statements. It is not that management is always doing frauds. There are such entities which have a very wide spread, geographical spread. An entity may have hundreds of branches. Say, for example, an FMCG entity may have hundreds of branches, hundreds of stores across the country from where their distributors, or hundreds of their own warehouses from where they distribute goods. Now, anybody could do a fraud at those locations. So the management has to make sure. So, okay, let me preface it by saying that the ultimate responsibility of ensuring that a fraud does not take place, that is the responsibility of the management. The auditor's responsibility is to make sure that they have steps to do the audit to ensure that those processes are followed, and when those processes are reasonable, that a fraud will not occur, and that the processes are followed and nothing untoward has happened. And that is what we write in that report. So ultimately, it is the management responsibility. So as we go and talk to the management, as auditors, we have to assess that what is the management's assessment that the financial statements are not materially misstated due to a fraud. So this is something the management has to tell us. The management has to have a process, has to have controls to ensure that no frauds take place, and that if any frauds take place, these are identified. So this is what we have to first assess, talk to the management. The management has to prove to us that there are adequate controls, we have to assess those controls. Any specific risks that the management has identified for or have been brought to its attention, or classes of transactions, account balance, or disclosures which the risk of fraud is likely to exist. We also have to look at what is management communication to those charged with governance, which is the board of directors, or the governing committee, or the risk committee, regarding the processes for which they've identified them. We have to also look at what is the management communication to its employees. The frauds can take place by employees, the frauds can take place by management. There has to be a framework where the management is cognizant that they have adequate controls to take care of those frauds. So if there are ethics trainings, there are trainings relating to fraud, there are communications, in which management is told that these are the consequences of doing anything wrong. So we have to see the underlying steps that the management has taken to detect, prevent, or detect any frauds. So this is what we have to inquire of management. We have to be satisfied that they have adequate steps. These have to be documented, that these are the management steps to ensure that no frauds are taking place. And if there are certain gaps, then we have to tell management that these are certain gaps and we need to plug those, and then our audit procedures have to be defined accordingly. So inquiries of management is very critical, that there is no lacunae left in the processes to ensure that frauds will take place. In addition to inquiries of management, we also can go ahead and talk to the internal auditors. We can talk to the audit committee of the company if they have any reason to believe a fraud has happened, or they're aware of any fraud taking place. We can also look at the whistleblower mechanism of the company, because that is also something which can determine if a fraud has taken place. So there are multiple documents within the company which an auditor can look at to ensure that the company has taken adequate steps, the management has taken adequate steps to ensure that there is a framework to detect or prevent any frauds. There are situations where those charged with governance, which is the board, may be involved in managing the affairs of the company. We have, in case that is the case, then we have to go to a body which is above the management. We have to go to the promoters, we have to go to the shareholders, as the case may be. We have to also see whether they have any knowledge of suspected or alleged fraud affecting the entity. These are the inquiries that we make with people to ensure that there is a framework to avoid any fraud. There may be certain, as we do tests, as we perform analytical procedures, we may come across certain unusual or unexpected relationships. Relationships is not really related parties, but we may come across situations where the company has been selling material to a particular party. We may come across instances where the sales are going up, but the expenses, say marketing expenses, are not increasing in that proportion, or increasing disproportionately, or remaining the same. So these are unexpected or unusual relationships that get identified. Now, these are relationships that can be that we need to be watchful of. We have to then devise our audit procedures effectively to make sure that if there are such matters which come to our attention, what are we doing to ensure that no frauds are taking place? In particular, one of the matters that we look at is the revenue recognition. Revenue recognition is always a fraud risk factor. One minute. Sorry, I've skipped the slide. And revenue recognition is always a fraud risk factor. So that is a that could be based on multiple factors as to why people wants to increase its revenue. Because when it increases profit, there are stakeholders' expectations. At times, in case of listed entities, the management has already kind of informed its, I would say, the board of directors or the others about certain results, and they want to stick to those results because the company's performance and their own KPIs are linked with those with the revenue. So that is one thing, and it is easy to, in case there are lack of controls on revenue recognition, it is very simple to inflate revenue. So these are some factors which are very critical, and these are, and I would say this is a presumed risk of fraud. So this is something which we have to ensure, and we have to work around that. And there are tests which we need to do to ensure completeness of revenue recognition, and also that no extra revenue has been recognized. In case for certain reasons, we think that revenue is not a presumed risk, there is no presumed risk of fraud in revenue, then that has to be accordingly documented. That is very critical to document, because otherwise it is a presumed risk for fraud. Now we'll deal with the identification and assessment of the risk of material misstatement due to fraud. What we do here is identify the risk of material misstatement at the financial statement level, at the assertion level, at the compliance level, and at disclosure. So there are certain entities which are required to give disclosures, particularly when they have taken loans. So these are, and the disclosure requirements are increasing, as we, on a year-on-year basis, as the companies finalize their statements. One of the recent disclosure requirements which has come in the last couple of years is the ratios. Now, those are, they may look small, but people tamper around those ratios. Because if they have taken loans, then the banks look at those ratios very carefully as to whether the leverage is correct or not correct. So that is why it is very important that, all the disclosures, the account balances, and at the financial statement level, we are able to identify and assess the risk of material misstatement. I said that revenue I have already talked about, which is the second bullet. The presumed risk of fraud is in revenue recognition. We evaluate the revenue transactions or assertion that give rise to such risks. Risk of material misstatement due to fraud is a significant risk. The entities related controls, including control activities related to any of these risks. What are the responses to these risks of fraud? In accordance with SA 330, the auditor shall determine overall responses to address the assessed risk of material misstatement due to fraud at a financial statement level, at an overall level. In determining overall responses of material misstatement due to fraud, the auditor shall assign and supervise personnel taking account of knowledge, skill, and ability. Now, again, I said that the people who are doing the audit, they have to have the appropriate skill to do the audit. This is also a requirement of the standards on quality control, that our teams that are doing the audit should have the relevant experience. Because unless and until they have the relevant experience, they will not be able to do justice. So we have to assign the right people, and we have to supervise the right people who should have the relevant knowledge and skill to do the audit, so as to determine the risk of material misstatement due to fraud. We also have to evaluate the accounting policies by the entity, which may be indicative of fraudulent financial statements. So these are the things that we need to do at our end: have the right team in place, evaluate the selection of accounting policies. The policies and practices in accounting are very critical. Although the policy may state something, but the practice may not support the policy. So one has to also look at the policy to support the practice. And this is now at the assertion level. The auditors have to design and perform audit procedures where the nature, timing, and extent are responsive to the assessed risk of material misstatement. Now, there is a material misstatement risk that has been assessed. Now, to assess that risk, there have to be the audit procedures have to be in line with that. So this is also to make sure that at the assertion level, at each assertion level, the risks are well defined and the procedures are to cover those risks. The management override over controls is the risk which is present in all entities. As I said right in the beginning of the presentation, the management is uh, the management has control over the activities of the company. They have access to the books of account. They have access to make entries to change the accounts. Um, and they can play havoc in case they want to do a risk, if they want to increase revenue, if they want not to decrease expenses, if they want to increase an asset or increase a liability. They have every reason. When we talk about misstatement, it's not only increasing profit or increasing assets. It could be either ways. What we as auditors have to make sure is that the financial statements correctly reflect the financial position of the company and the financial results. So even if the results are being depressed by fraudulent activity, that is not also a good sign, because that has implications on taxation side, and also results would vary from year to year, depending on what the management's intentions are, or the management's requirements are. In a particular year, the management may not want to show a very high profit or want to transfer the profit to a next year. That is also not right. That is also a problem. So we have to, at that point of time, notice that the management there are steps that the management does not override its controls. So what are the steps that one has to perform for these kind of cases? uh, the, these are some of the broad procedures you could do. One, it comes from the auditor's experience and the auditor's experience on the audit. So one has to test the appropriateness of journal entries. Journal entries are the most susceptible to creating fraud in an organization. So the journal entries can result in adjustments being made in the preparation of financial statement. So look at the journal entries, look at journal entries which are outliers. There are multiple ways in which journal entries can be looked at today. There are tools to look at journal entries which have been recorded. One can sift through the journal entries by means of artificial intelligence tools, by means of data analytics. So go through those journal entries, test the appropriateness of those journal entries. Are those journal entries appropriate? When we when we pass the journal entries through certain tools, one could look at journal entries in a particular account being passed over a certain value. For example, in a particular case, if it's an FMCG company, we know that the normal sales invoice is between rupees 10,000 to rupees 50,000. We can put a stake. We can look at all entries which have been recorded over 100,000 rupees, over a lakh of rupees. And if things come out in that, then one can also look into those and see whether these are correct transactions. So this is what one needs to do to look at journal entries. Is there a one-off journal entry which is being reported in the accounts? Just say debiting sales and crediting a fictitious, crediting sales and debiting a fictitious debtor. So these are the kind of journal entries which needs to be picked up, particularly closer towards the year end, because that is the time when these adjustments are made. One very critical aspect of looking at frauds is the accounting software that the company is using. Does it have an audit trail? If it does not have an audit trail, the work of the auditor increases significantly, because then one has to do multiple other tests like analytical procedures, looking at, reviewing the ledgers and other things to ensure that, there are no untoward entries which have been reported. One also has to review the accounting estimates. Now, accounting estimates are matters which can really alter the results of any company significantly. So one has to look at the accounting estimates for biases, evaluate whether these could also have a material misstatement due to fraud. I'll give you a very simple instance. In accounting estimates, there are companies who have high risk on debtors. So the best thing is don't make a provision for debtors. So this is an accounting estimate. The other accounting estimate is, these days for finance companies, there is an ECL provision that is created. There are millions of borrowers that the company has. Just change the accounting, the ECL percentage by a fraction of a percent, say half a percent, and the entire results will be different. Whichever it is, higher or lower, the results will be completely different. So these are some of the things that one has to look at, that are the estimates appropriate? Because these estimates, which if they are not appropriate, then they will result in huge difference. In insurance companies, there is a provision which is made for losses for claims. Again, that is done by an actuarial provision. The company can give the actuary a wrong assumption. So these assumptions have to be tested. In a manufacturing company, you could have a wrong estimate for depreciation. Your plant and machinery may last you, say, 5 years, but you're depreciating it over 2 years or over 10 years. So both the ways it is wrong. So this also represents a huge, huge problem. So these are things which have to be looked at. So test the appropriateness of the accounting assumptions. And once you test the basis of these accounting assumptions and you think that these are not appropriate, you have to challenge them and get them corrected. Now, these are also fraud risk factors. And these accounting estimates also should be disclosed to those charged with governance in the presentation that you make to them at the end of the audit, that these are the assumptions used. And we concur with these assumptions. Because if you don't concur with those assumptions, then you have a problem with the account. So there are certain transactions that are outside the normal course of business for the entity. For those transactions also, which are outside the normal course of the business of the company. For example, an insurance claim. Now, this is something which is unusual. This does not take place on a day-to-day basis. In these circumstances, you have to look at the documentation and see whether the appropriate entries have been reported. These could also change the flavor of the financial statement significantly. Now, we have to evaluate the audit evidence. When we are performing analytical procedures to come to an overall conclusion, there are lots of analytical procedures that are performed as we do an audit. I'll tell you very simple ones. The ratio of tax to the profit before tax. So one would look at that. One would look at what are the number of days of debtors to sales. What are the number of days of creditors to purchases or to cost of consumption? So these are some of the analyticals that we perform. Or one would look at analyticals in respect of what are the monthly sales, what are the quarterly sales? Is there a big jump? Not a big jump. Now, when we are evaluating the analytical procedures, which help us in forming an overall conclusion on whether the financial statements are consistent with the auditor's understanding, and these are some things which we have to look at. Evaluate, then we have to evaluate whether such a misstatement is indicative of fraud. Management, in particular, senior management, if they are involved in fraud, we should evaluate the reassessment of the risk of material misstatement, which could result in the nature, timing, and extent of the audit procedures. So, in case we have any such indication, then we have to see what are the audit procedures we have to perform to ensure that nothing is wrong. In case we are unable to conclude based on all the tests that we do after we do our audit evidence, whatever, in case we are unable to conclude, on the financial statements, we're not getting information or the nature of fraud is very pervasive, then we have to see what is the implication on the audit. Whether we have to give a qualified report or we have to give a disclaimer or we have to not do the audit. So these are some of the things that one will have to evaluate in case the audit evidence proves otherwise. Now, I said, look at the audit, whether we have to do the audit. Now, the auditor may not get adequate comfort. He may not be able to do certain procedures where he has doubts on whether it is a fraud or whether there is management override. Then the auditor has to see whether he will be continuing with the engagement or not continuing with the engagement. The auditor will have to determine the professional and legal responsibility depending on the circumstances, whether he has to report to somebody within the company, whether he has to report to the shareholders, the board of directors, depending on the nature. Normally, who do you report to? One has to report to one level higher than the one where you have a problem, where the fraud is expected to occur. For example, if the auditor thinks that the fraud is happening at the operating level, say at the CXO level, the CFO level, or the operating, the COO level, then he has to go to the directors, the CEO of the company. If the fraud is at the CEO level, then he has to go to the board of directors and inform them. So one has to determine as to what level does he have to inform. In case it is happening at a company level, then one may even have to go to the regulatory authorities, because today the Companies Act casts a responsibility on the auditor to cast a responsibility on the auditor to report to the MCA in case of fraud is taking place. So the auditor may at one point of time have a view that he will not be able to continue with the engagement. So we have to consider whether it is appropriate to withdraw from the engagement or it is legally permitted to withdraw from the engagement. Today, even if an auditor has to resign for any reason, he has to write to the MCA that he wants to step out in the MCA, and he has to give a reason for the withdrawal. If the MCA is not, I would say, not satisfied with the reason of the withdrawal, they may not allow withdrawal, and there are certain rules which are there by the MCA. For lack of a word, I'm using the word rules. That if you are resigning within a certain period, you will have to complete the review. Say if you resign within 45 days of the year end, you have to complete the review for the next quarter. If you resign after 45 days. So, all those rules come into play as you resign. So there is a professional requirement to report. So one has to make sure that it falls within the appropriate framework. Now, as we do our audit, it is a responsibility to take management representations. Having said that, we can't say that we've taken a management representation, there is no fraud, and that takes care of our responsibility. No, that is not right. It does not absolve us from a responsibility to do our audit procedures. So what we have to take from the management is that one, since I said right in the beginning that it is the responsibility, the responsibility of preventing and detecting frauds primarily of the management. So one, we have to take a representation that the management acknowledges that it is their responsibility to detect and to prevent and to detect frauds. So they have to give a responsibility statement that the design, implementation, and maintenance of internal control is their responsibility. So that is the most fundamental underlying representation. So if they have taken steps to do that, they have to first take responsibility for them. Then the management also has to disclose to the auditor the results of its assessment of the risk. There are multiple ways in which risk is assessed. The companies have to have a risk control matrix. For each of the processes that the company follows, the company has to have a detailed step, they have to perform detailed steps as to what they have done to ensure that that they have followed the process and that all the processes have been followed correctly. So the management has to first make a representation to the auditors that they have taken all steps, they have followed all steps, and that they're all working fine. For example, if there is in purchases, if there is a process whereby the company has to have the requisition by the user department, and then that requisition goes to the purchase department. The purchase department should have a list of prospective suppliers who will supply that particular material. And the purchase department will go to the suppliers to obtain quotations. The quotations will be evaluated by a committee of purchase personnel by the head of the department, and then it will be opened in a sealed envelope. So all those processes are defined. So one has to see that those processes are defined. The management has to first do an assessment on its own that the processes are working. And then the auditor, through its walkthroughs and control testing, makes sure that these processes are working. So what the auditor is doing is actually reliving what the management has done. It is testing the management's controls. It is seeing that whatever is laid down, the process is being followed. So what I'm saying is the management has to disclose that the results of the assessment of the risk that the financial statement is materially misstated as a result of fraud. So they have done the assessment and that the material financial statements are not materially misstated. It has to also disclose to the auditor if they have any knowledge of any fraud taking place in the organization which involves management, employees, or any other material fraud. The management is also to give a representation, and if there is nothing, the management has to say that we have done this and we are not aware of anything. Then the management also has to give its knowledge of any allegations of fraud. There may be allegations, there may be whistleblower complaints of any fraud, suspected fraud, affecting the financial statements, communicated by employees, former employees, analysts, regulators, or others. So the management also has to let us know that there is no such thing, and if there is any matter, how the matter has been investigated, reviewed, and resolved, and if any of those matters have caused any harm to the company of any financial nature which will affect the financial statements, that has been appropriately dealt with. So these are the representations that we need to take from the management. Having said this, the management may give whatever representation. It is the auditor's duty to ensure that adequate steps are taken to detect any such frauds. Now, can I just take a break for a minute and be back? I'll just be off for half a minute. Yes, I'm back. I just want to take a half-minute break. Okay, now what is the communication that an auditor has to do to management? If the auditor has identified a fraud or has any indication that that fraud may have existed, this should be communicated to the management at the appropriate time. Now, who is to be communicated? As I told you, it has to be one level above where the fraud has been identified. So determining the appropriate level of management is one's professional judgment. So it has to be communicated. This is the fraud. This is how we found the fraud. This is the expected fraud. And then the further investigation has to be done. So communication is extremely important. The manner in which the communication needs to be done is to determine whether it is verbally or it is by writing. But there has to be a trail because the management should not turn around and say that they were not aware or they were not informed by the auditor. So one has to take appropriate steps on that. So unless all those charged with governance are involved in managing the entity, if the auditor has identified or suspects fraud involving management, then these are to be communicated with those charged with governance, which is at times the audit committee or the board. So the entire fraud has to be discussed, and one also has to discuss the nature of tests that have been done, and the extent of audit procedures that have been done to complete the audit. And based on the tests that have been done, then appropriate reporting needs to be defined. Uh, the auditors also have to report on the internal control over financial reporting. So the auditors have to see, in case a fraud has taken place, whether it affects the financial reporting controls or not. And accordingly, within the framework of that reporting, do the appropriate reporting. At times, communications have to be made to the regulatory and enforcement authorities as well. There is a clause, there is a section in the Companies Act which says that in case there is a fraud, a communication has to be made to the Ministry of Corporate Affairs. So that is one, that is again depending on the nature of the fraud and the extent of the fraud. That communication has to be made to the regulatory and enforcement authorities. For example, in the case of a bank, the auditor has a duty to report to the supervisory authorities. So in case where these reporting is not done, there may be a professional misconduct on the part of the auditor not to have reported this to the appropriate authority. Now, there is our documentation standards is not documented, not done. So whatever we have noted in case of the fraud, we have to document all that. So we have to document the understanding of the entity, its control environment, the assessment of the risk of material misstatement, all that has to be documented. One has to document all what we've talked so far, that has to be documented. What are the discussions that have taken place with the management, the discussions that we have done with our engagement team, the fraud risk factors that we've identified, the extent of testing that has been done to ensure that there is no fraud. For example, the journal entry testing, the basis of selection of vouchers, all that has to be documented. Then we have also have to document what we have discussed with the with those charged with governance or with the management. In case any fraud has been identified, what steps have been taken to report to the management or to the regulatory agencies as the case may be. So everything has to be documented. So this is what I've just talked. Communications about fraud made to management, those types of governance, rebuttable presumption of material misstatement due to fraud related to revenue recognition. If not applicable, then documents for that. So all these matters have to be documented. So this is all from my side as far as the discussion on this particular auditing standard is concerned. All I have to say here is that one has to be careful. One does not have to only go by the auditing standard. One has to look at the various circumstances, the material, what are the reasons, for the understanding of the entity, where frauds could take place. So it starts right at the beginning. Do not just go by the standard, use your own hunch, see what is the right step to perform. A lot of issues come up as one looks at the financial statements. If there is something irregular in the financial statements, if there is any suspicion towards anything going wrong, look at that. Do not delve so deep into it, without any reason that you start suspecting everything. But as soon as there is an indication of fraud, if there are fraud risk factors, please attend to it and do the necessary work and inquiries to ensure that there is, you cover your tracks as an auditor and there is appropriate documentation to take care of that. With this, I'm happy to take any questions. I know I have completed well before time. The time allotted was much more, but I had nothing more to discuss on this one. Over to you, Anil, in case you want to say something.
Thank you so much, sir. Thank you so much for your precious time, and thank you so much for your wonderful deliberation. Sir, we are trying to fetch certain questions due to the technical glitch. We are not in a position to fetch all the questions. But at the initial time, we have received 2-3 questions. One is, sir, as per the FAIS, even forensic audit word is not used, and we cannot form an opinion on fraud. Instead, forensic accounting is used. The expectation of regulators and LEAs are very high from chartered accountants. How to tackle this?
As I said, the expectations are, yes, very high.
Yes.
There is no doubt about it. That is something which I said right in the beginning of my presentation. The expectations are very high. How to tackle that is to make sure that we have adequate documentation in our files to ensure that our auditing standards, the standards on quality control have been followed. If we have that documentation that we have done our work, all steps have been taken. That is one way. Yes, it takes a lot of effort. I know it takes a lot of effort because when we have to do the documentation, uh, the staff that we use, all of us use, the chartered accountants or the semi-qualified staff, use are all the same. There is no difference. So it takes a lot of effort for them to do this documentation and for the supervisors in our firms to supervise the documentation to make sure that they've written the right things, because at times wrong documentation can also land you in trouble. So make sure that the documentation is that all the steps are followed. It is not too much. I'm telling you, the only thing is that we have to be sure of what we have done and that it has been appropriately taken care of. In case there is any suspicion, I'll tell you a very small incident. We were doing a review, and in case in that particular account, we saw a commission of a very large amount. When we inquired on what this commission, actually it was not commission, it was professional fees paid. It was much larger than the previous year, and the business remained the same. So when we inquired into that, what is the professional fees? It came out that a professional fees was paid to a consultant. When we further probed what is the documentation, there was no evidence. Then one of the management team members told us, that this was paid because we could not realize some money from a particular department of the government. We had to pay this to a consultant so that, we could pay it off there. Now, this is clearly not acceptable. This is an illegal payment. That this is in the nature of fraud. So these are the kind of things which come up in our review. So what have we done after that? If we just leave it like that, yes, this is a professional fee, there is a bill. Now, you have to further probe and see whether is there any documentation for receipts of goods and services. If there is no documentation, then these are factors which lead you towards a fraud. So I'm just giving one small instance of this one. So there could be multiple other instances. There was one particular instance where this is the old days when checks were not clearing. So checks were not clear for 6 months, 7 months, 8 months, a year. There were checks which are not clear for 1 or 2 years also. When we went to the detail, we noticed that there was a person who was not presenting checks in the bank and he was passing bank entries. So these are and he would fudge the bank statements and then get us the bank statement because he had been handling bank reconciliation for a long time. So these are instances which point towards a fraud. Now, what have we done about it? If we document all that, then at least we are safe. Now, if nothing comes out, then at least we can say we've done these checks and balances. We've taken direct confirmation from the bank. We have taken a confirmation from the customer. So these are the kind of things that one can do. So what I mean to say here is the nutshell in which I would like to say, or the gist is that do your work and document your work. Both are important. Not documented is not done. If a regulator picks up your file, his expectation is high. He expects to have a record on the file. In one of the cases, the regulator told me, I'm just taking half a minute now to explain this. He told me that if you have written that you have done this, that also satisfies me. You're not expected to keep a whole document on record. But if you say that you've done this, I will believe you. Having said that, there is no one solution to every problem. What I would suggest is that having done it, keep a brief track of what you have done. At least keep the document reference with you on file. If it is a small document, keep the document on file. So make sure that the documentation is that is the only way we can kind of satisfy a regulator.
Yes, sir.
Over
Sir,
to you.
but sir, in this, whether auditor is liable to detect the fraud or liable to report only the frauds already committed?
Both things. You have to, in case in your duty, there has been a fraud and you are not able to detect the fraud, and if it is of a significant nature, then the responsibility falls on the auditor that you've not been able to detect a fraud and you could have done the same in the ordinary course of your audit.
Yes,
So
sir.
there the responsibility is that you should have detected and reported. Right? Now, in case of reporting alone, if there is a fraud which has already happened and management has reported the fraud to you, then it is a responsibility of the management to have reported it to the regulatory authorities. And if they have done it, then the auditor can refer to it that this has already been reported and we have been informed. But since the management has reported, the auditor's responsibility reduces in that case.
Yes, sir. Sir, if the audit is conducted for a very small percentage of the records, only small percentage of records are given out of the total business with the branch, then how the auditor is responsible for anything which is left out?
In case you have seen the financial statements, in case you think that the whole gamut is not covered, then that is a scope restriction. If it is scope restriction, then you can give a disclaimer on the audit. You can modify or give a disclaimer.
Yes, sir.
If documents and records are not
Uh,
produced, it's a clear scope restriction on the audit.
yes, yes. So if a member of a management, that is the director of a company or partner of a firm who engaged him for conducting audit, is involved in the fraud detected by him during audit, what shall the auditor do? Shall he report the fraud at the expense of losing his engagement as auditor?
Yes, he has to. That is the duty cast on him by the by law. If he doesn't do that, then he is
Hmm.
himself being unlawful. He has to report the fraud. He has to lose. He obviously he will not want to do an engagement where the owner, the promoter, or the managing director is perpetrating a fraud. He has to report it to the next level. The next level, if he's the next level, then obviously he has to report it. If depending on the nature of the fraud, he has to report it to the regulatory agencies. For example, I'll give you a very small example. It's been a very recent case also. It's been in the press. I will not take the name here. The promoter himself, he had asked a PE firm to invest money. He was himself the promoter. He had a lesser stake now, but he was sacking money. The directors picked it up and they reported this thing. It blew out of proportion, and the person was removed from the company. So the auditor's responsibility was to report it. He reported it. He did not lose the engagement because there were other shareholders and other directors who realized that the auditor has done the right job. So the point is that it has to be reported.
Ji. Sir, what member is asking your as a gist or your expert in a very gist manner, what are the steps the auditor has to take when management has identified a material fraud against the company executed by an outside consultant?
So the management, an outside consultant, has done
Yes,
a
management
fraud
has
on the
identified
company,
this.
and the management has identified the fraud. So the auditor, now there is no guidance on this kind of a thing, but the guidance comes from the various auditing standards. The auditor will have to alter its procedures to modify, not alter, modify its procedures to enhance the coverage of the nature of fraud that the person has committed to ensure that it is a fraud, first of all. The management may say it is a fraud, but it will not be a fraud. So one has to first ascertain that it is a fraud. Having ascertained it is a fraud, then the management has to report it to those charged with governance, which is the audit committee or the board of directors of the company. That this is what has happened. Now, I'll take an example here. The general manager has found that the consultant has done fraud. So in the first place, he should have informed the board of directors. And he should have informed the regulatory agencies that this fraud has happened. The regulatory agencies could be the police also in this case, could be the MCA, could be the income tax authority, whoever may be concerned, could be the RBI interest of the bank. So he has to inform the appropriate regulatory agency and he has to inform his board of directors. The auditor in this case, if everything has been informed, he has to then say what audit procedures he has performed to 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 prove what the person has reported is correct. So the audit procedure formed to ensure that the fraud is only limited to that much and not. So the auditor will have to perform procedures to substantiate that fraud.
Ji, sir. Ji, sir. Sir, what is, in your opinion, the management representation authenticity in the eyes of investigated agencies, whether it is in the favor of auditor or otherwise?
Look, the management representation that you are taking holds good if there is, if there is no fraud. One. Second thing, I said that during the course of my discussion that it does not absolve the auditor from doing his duty. So the management representation will hold good. It will put the management in the appropriate light that they were either negligent or they were themselves party to the fraud. But if we have done our procedures, if there is a fraud, assume there is a fraud, we have done our procedures and the procedures bring the fact that we could not have in the normal course of our audit detected it, then we will be safe. But if in the normal course of our audit we could have detected the fraud, then it will have to be proven to the regulatory authorities that we had actually done that. So the regulator will only take cognizance, it will only put responsibility on the management, but it will not absolve the auditor if he has not done his job. So the auditor will have to prove that he has taken the necessary steps. That is why there is a phrase which says nature, timing, and extent of the procedures performed. Nature, timing, and extent. So these three things are there, that these have to be appropriate, keeping in view the nature of the circumstances.
Yes, sir. So last question relating to the previous query only. Member is saying further to my previous query, is section 143 subsection 12 attracted, that is the unreported income, is that fraud and it is detected by the tax authorities and not by the auditor? It is to be counted as fraud.
Yes, it is to be counted as fraud. And I don't recall the section right now, but under 143.12, the auditor is expected to report fraud. That is what my understanding is. I don't have the section in front of me because at times, we may have read it, but it may not be at the top of our minds. But under 143.12, if there is a fraud which has been committed and it is detected and it has not been reported, the auditor's responsibility is to report it to the regulatory agencies.
Yes. Thank you so much, sir. Now we come to an end. And on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I extend my heartiest thanks towards you for sparing your valuable time. And in spite of your busy schedule, as well as the pre-engagement for this particular slot, you have given your kind consent for this today's webinar. So thank you so much, sir, once again for sparing your valuable time.
मैं एक बार कहना चाहूंगा, आप तो मेरे पीछे बहुत टाइम से पड़े हुए थे, बट आज कर ही लिया हमने। मेरे को बड़ी खुशी है कि हमने आज ये कर लिया सेमिनार, नहीं तो ऐसे चलता रहता है, हमको टाइम नहीं मिलता। और
थैंक यू सर।
ये तो ऐसी चीजें जो हम हर रोज करते हैं, तो इसमें तो हमको बहुत ज्यादा एफर्ट नहीं भी करना, पर हाँ, एक बार पढ़ना जरूर पड़ता है आने से पहले यहाँ पर। But thank you so much, and thanks to all the listeners and to all the participants, and happy to help you, Anil, and to the to the board at any point of time.
Thank you, sir. Thank you, sir. More than 1,500 members are live, sir.
Thank you so much.
Thank you, sir. Thank you, sir. Thank you. Thank you.